it's that sounds like just a absolute like you're a circus orchestrator. And
Yeah.
what is happening, DeRosa Insiders community? This is Matt Faircloth, and welcome to the Cash Flow Digest. My name is Matt. Our company is called the DeRosa Group, and we are a real estate company dedicated to transforming lives through real estate and teaching other operators just like you how to build a business just like we did by transforming lives through real estate and seeing the human side of this business as well. That's what we're all about. We're about conveying that message. So if you guys love that, we love you too. And we want you guys to love this show by giving a like if you guys are watching a video of this on YouTube. You guys are watching a video of this on Spotify. I want to talk a bit about our guest. We've got a great guest coming in. Like I said, I love talking with other operators. And so my guest today is Mike Zaransky. We're going to bring him. Before we hop further in, could you just give us a brief backstory, brief introduction to our audience for those that haven't heard of you? Give us a quick intro.
Sure. I've been in the multifamily apartment business really most of my adult life. My father and grandfather before me were in multifamily, kind of grew up in it in my blood. My son is now in the business, so I guess technically we're a fourth generation business. Although in the real estate business, as you know, Matt, the business is really only as good as whatever your current and last deal was. So it's not like a passed down family manufacturing business that has a plan and continuing to grow. So we make things happen every day on our watch. We are a national firm, even though we're based in Chicago. I'm born and raised in Chicago. We have a fair number of assets in the Chicago market, both suburban and city. But we branched out to lots of markets. Over the years, we built a student housing portfolio on 7 large college campuses. Held those for 8 or 9 years, exited those about 3 or 4 years ago. We were the largest off-campus landlord at 2 campuses, Purdue University in West Lafayette and Notre Dame University in South Bend, Indiana. And then we had 5 other campuses as well. And our current focus is conventional market rate apartments in the suburbs and the city. We focused in the Texas market currently, in the Tennessee market, and in the Chicago metro market. We do both ground up new construction development, which we've done successfully, as well as acquisition of existing assets, usually where there's a value add component where we can bring something to the table to raise the cash flow of the property and the overall value.
Yeah, that's great. I mean, diverse portfolio, generational lessons, I'm sure, that got passed down. So lots to unpack there. I don't get to talk, our audience doesn't get to hear much from folks that are doing the student housing game. So I'd like to just, only because it's interesting, put a bit of a spotlight there in that. So how'd you get into building student housing at colleges, and why'd you stop doing it?
So how I got in, I wish I had a great master plan strategy story that I mapped out this great plan and I saw what was going to explode in the student housing market. But the truth is,
Michael's got the next 50 years of his business life planned out, right? And that was just the
as
he was
you
on,
know,
right?
Matt, it doesn't work that way.
Of course.
What really happened was I had sold an apartment building at a very nice gain, put the money in a 1031 exchange, was searching for a replacement for the property in the market. It was Chicago suburban, and found that pricing was just like ridiculously crazy. Cap rates were very low, and many buildings at that time were being sold to condominium converters at very high per unit prices that didn't make any economic sense to run rental apartments. So I found an apartment building available for sale at the University of Illinois in Champaign-Urbana, which is my undergrad alma mater. It fit the bill. Student housing assets at the time were trading at 7 and 8 caps. It was a very attractive return.
Yeah.
I found a local manager and I put the 1031 money in that and started learning more and more about the business, and then start expanding on multiple campuses and realized and then really got into the strategy, studied the demographics, saw the explosion in the number of students that were becoming college age, the increased percentage of students who graduated high school that were going to colleges, and identified certain campuses and really only bought existing stabilized assets, old fashioned real estate of buying assets, raising rents at renewal. A lot of demand, built in demand, raising rents from year to year, improving the market, doing refinancings to take cash out, and ultimately selling the properties into a market where student housing got very, very hot, a very favorable asset class with some
Mm.
public companies in it and institutions in it at very, very low cap rates, and did very well on that portfolio.
Mhm. Okay. So, what is the management game on student housing? I have a few friends that do it, and the only I know I've heard of is that lease up, as you and I are used to on market rate or call it workforce housing stuff, like lease up occurs all year round. Whereas lease up in student housing pretty much occurs in a 2 week process where that's
Yeah.
when they all move in. And that. So, you talk us through that and talk us through other management nuances and comparing student housing to the other market rate stuff that you've done? How's it different?
So, a much more relaxed and the pace of market rate operation is so much more relaxed and chilled
Mm.
than student housing. I'm out of it, but I'm not complaining because it did
Got the
very well in it.
battle scars to prove it,
Yeah.
right?
But two major things, and you hit on one of them that makes student housing different, aside from the fact that you're dealing with students on a day by day basis, is one, the leasing window is
Mhm.
very compressed. You start different campuses have different customs as to when they start leasing. Many of them start as soon as the kids come back to school in the fall for the next year. Some start in January following. But if you are not fully leased and occupied by the time the middle of August comes around, which is the start of the school year, whatever is vacant is going to be vacant for an entire year.
Mhm.
Unlike having the luxury that we have in the conventional apartment business to be able to rent an apartment that's vacant or comes due by offering a concession or a gift card or whatever at any given time on the calendar to get it occupied. You don't have that luxury at student housing. There is no market to rent it comes the start of school.
Yeah.
So being on top of the leasing process, very intense, yeah, very much so. The other
Yeah, I
thing,
mean, like, if occupancy goes up, you and I could just have a move-in special. We could offer a little bit of a credit, and I can take occupancy from 85 to 95 in maybe a couple of months on a larger asset.
right?
We can't do that student housing. If you're walking into the year at 80% occupancy, you're going to be suffering through 80% occupancy for that whole year. So it
12
sounds like it's
months, yeah.
feast or famine. Yeah.
So that's one
Um,
thing. And then the
Crazy.
other thing is very rare in a conventional property. You don't see it in a conventional property. The turnover and move in is all within a 10-day period where you have, obviously you're going to have a percentage of the students that renew. It's not as high as conventional because people find different roommates, they find a new place, or they graduate.
Yeah.
Um, when you have to replace that with a new tenant that you've signed a lease for, you have to turn the unit when the other student moves out, and you have to move in the new tenant. And every single new lease that you've written for that building for the year is moving in within the same week. So as a result, the turnover is massive. The crews that are required for paint and carpet and
Yeah.
replacing, appliances and things is a massive undertaking. And you're in a college town, which usually is a small town, where everyone is in the same situation. So the third party vendors are spread real thin. The painting contractors are spread real thin. So you got to have all your ducks lined up for that very compressed time. And then, of
Yeah.
course, you have, as you kind of might imagine, the real emotional part of it is that's when you have mom and dad show up to deliver their child to their apartment and move them in. So during that week when everybody's moving in, you're dealing with mom and dad who care about things that should be taken care of versus the students that may or may not need immediate service on a leaking faucet or a little imperfection in the wall over the bed that
Yeah.
needs
And
to be.
mom and dad with their delicate little snowflake cannot have chip paint on the wall,
Yeah,
right? Whatever it may be. So, I mean, it's that sounds like just a absolute like you're a circus orchestrator and
Yeah.
in all that, and bringing all that labor in, which are probably in small little towns, like you said. So you're not in like, couple million person communities most of the time.
Yeah.
So you having to bring them in from outside. My guess is some of these contractors out there kind of smell blood in the water. So all of a sudden their price to
Yeah.
paint that unit triples versus
Yes.
what it was, because they know that you are in a bind and you got to pay it. So doesn't sound like fun. What's financing like for student housing? Is it you're not getting Fannie, Freddie, the stuff that you and I are used to? You're not getting those
Yeah,
guys.
in the days that I began, Freddie and Fannie were not available.
Okay.
It was still considered kind of the animal house asset class.
Yeah.
And it was either local banks or our own banking contacts, which we use, or CMBS loans, which we did a fair number of back in the '08, '09, '10 period. Of late, and towards the middle of our ownership, and over the last, I would say, 15 years, student housing has become a favored institutional asset class.
Hmm.
So that at quality schools where there's good past performance on income and expense statements, there is readily available both Fannie and Freddie loans now. They have a student housing platform, as well as major national institution lenders on a non-recourse basis, just like large conventional deals.
Oh, okay.
Yeah.
Well, that's good to know.
Yeah.
And so to save your sanity and less agita, whatever you may, I mean, you had enough fun, let's say. And obviously, as you said, cap rates had gone down. You bought it at a higher cap rate. It became more of an accepted asset class, so to speak. And maybe cap rates go down because of what you just said, because financing had changed, and that's something to keep our eyes on. Is as accessibility to that asset class from a debt perspective changes, that might change people's affinity to it. Like, let's just say this isn't going to happen, but let's say Fannie Mae decides they want to start funding retail strip centers, right? Or a even better one, assisted living, right? Because they maybe could do that,
Well,
because there are
yeah,
there are humans
yes.
that are in assisted. Yeah,
Arguably, yeah, multifamily. Right. Right.
right. They're in my right. Multifamily with a lot of other services to it. And so, like, you're right. That's kind of the weird stepchild of housing right now, is assisted living facilities. And a lot of our friends are doing it. I don't know if you guys do that. A lot of people I know are in that world. We're not, but
Yeah.
let's pretend that Fannie and Freddie decide they want to start financing that. I'd be willing to bet that the cap rates in that world would drop quick, because the cost of
No,
capital, the accessibility, the LTVs would all change in that.
no
Like,
question about it. One of
yeah.
the things that I love about the multifamily business, and student housing got swept under it. And by the way, kind of the closer leap for assisted living to make the case that it could happen one day, 55 and older communities, which are very common without massive services, qualify for Freddie and Fannie loans.
Mhm.
Um,
That changes.
but one of the things that makes me comfortable with the low risk of investing in multifamily, aside from just knowing it and being comfortable with it, is that Freddie and Fannie, even if you don't use them for your own deal, if you use a bank, they provide liquidity in the market that has been there consistently that other assets classes don't have. As an
Yep.
example, we keep talking about office. You can't get anybody to give you an office loan right now.
Mm-mm.
Hospitality is pretty tough still, too,
Mhm.
the hotel sector. But a multifamily deal that has an operating history with cash flow that could be underwritten can get financing and can get it at attractive rates, and many special programs that make the rates even lower through the agencies. And it's just
Yep.
a great liquidity source to keep the value of the asset high.
Yeah. Yeah. And I mean, it makes sense, because our government needs there to be affordable housing in the world, right? There needs to be a affordable place for people to live. It is one of the foundational needs of society in that. And so it makes sense that there is that, and the government does get involved to make sure that there's an incentive,
Yeah.
right? Maybe not throwing direct dollars into mine in your pocket as that, but they're at least providing a vehicle that makes our lives a little bit easier, and keeps things flowing in the housing market, right?
Yeah,
Um,
the other thing it's actually been a good investment for the government to back these loans as well, because I don't know what the number is, but the current delinquency of Fannie and Freddie underwritten loans is like way less than 3% in the whole
Yeah.
portfolio.
They didn't take it on the chin during COVID like a lot of other lenders did. They got ahead of it. They did workouts. They did,
Yeah,
they even did, not debt forgiveness, but like you could do payment holidays and stuff
yes,
like that. And that now we looked at some of that, and obviously because they're the government, because they're out to protect housing, they're going to require eviction moratoriums and that kind of stuff.
right,
And also,
right.
and that, I mean, you're still dealing with the government that's
Comes with
trying
good
to
and
look
bad.
out for
Yeah,
everybody.
yeah.
Yeah. Yeah.